Hey everyone, welcome back. And in this video, we are going to discuss what is an annuity. So an annuity is really just an account with an insurance company. It is an interest-bearing account with an insurance company. And if you watched any of the previous videos, then you know that an annuity does not change the original product. So again, if it was an IRA before and you roll it into an annuity with an insurance company, it is now an IRA annuity. If it was a Roth IRA before, now it is a Roth IRA annuity. It doesn't change the tax status. And maybe I'm beating this too hard, but when I first got started, I thought I heard something like where if I rolled it into an annuity, my client would no longer have to pay any taxes on their money. I thought it was like this hidden secret. That is not accurate, not true, okay? If your client has an IRA and that is tax deferred, not tax never, it's tax delayed, tax deferred, then at some point, it doesn't matter if it's an annuity or not, they're gonna have to pay taxes on that money. It was originally called annuity because it could give you an annual income. Some people will say, well, I hate annuities, or, and not really know why. And you could say, well, Social Security is actually an annuity. Well, what does that mean? Well, it gives you money every single month and every single year, and that's what an annuity annual does. Don't be a smarty pants, but Social Security is like an annuity. If you win the lottery, and you could take your money as a lump sum, or you can opt to have an annuity over 20 years. Why would someone opt for an annuity over 20 years instead of taking it all as a lump sum? Because it's structured, it actually will give you more over the 20 years than that lump sum will give you. If you've ever watched daytime television, there are commercials that say, I want my money and I want it now.
It's my money and I need it now.
And if you've never seen these commercials, that's fine, right? But there are these people in this commercial, and this lawyer gets them their money, okay? And the reason why he had to get them their money is because their money was structured as an annuity, where it gave them money every single month or every single year. And it's not necessarily a bad thing. It can give you structure, exactly why it's called a structured settlement. Well, it's not exactly why, but it's called a structured settlement. An annuity is not a good or a bad thing. It's just a matter of if it lines up with your client's goals, right? If your client is saving up money to buy a house and they plan on using that money in 1 year, it should not go inside an annuity, okay? But we're going to discuss different reasons why it could make sense and why it would be beneficial for your client to have an annuity. So annuities are typically meant for a lump sum, meaning like 99% of them, someone has 10,000, 20,000, 100,000, 500,000, 900,000 already sitting in an account, and then we roll it to an insurance company. And all we're doing is really moving it from one pocket to another pocket, okay? So we do have annuities where a client can start by paying $100 a month or $500 a month. But for the most part, these are meant to be lump sum rollovers. Why would a client move their $500,000 from where it is to an annuity? Because annuities can provide safety and they can provide certain guarantees. One of the guarantees that it can provide is something called lifetime income. So it can give you a set amount of money every single month or every single year, so that way you never run out of money. A couple of decades ago, people's number one concern was, what if I die too soon? And typically that is solved through life insurance, right? If you die too soon, you want to make sure that the income that you're bringing in, that there's still something for your family who's depending on you. But recently it has more so shifted to, what if I live a really long time? Like, how do you know you've saved enough if you don't know when you're gonna die? And you don't necessarily want to be 88 or 92 years old and run out of money, because you can't really go back and join the workforce, right?
How do you do, fellow kids?
So you want some peace of mind to know that you will never run out of money. And annuities can do that. They can give you a lifetime income So if you die early, your family receives the balance. If you live a really long time, then you never had to worry that you were going to run out of money. The three most common strategies for annuities are what we're going to discuss here. And one is for growth. They really don't have any purpose for it necessarily. They'd like to be able to pull money out here and there, maybe go on vacation or just as needed, but they really don't need it for anything particular. They would just like for it to grow and do something more than just sit in the bank, right? The second is called leave behind money. Well, that's what we call it, right? They really don't need it at all while they're living. They have other assets that they're going to rely on, but they would like this pot of money, this bucket of money, to grow to be as much as possible on death. And there are annuities that can do that. And the third, I feel like that's most of like middle America. Sure, it would be nice to leave behind as much as possible for the kids, but they want the money. They need the money to actually live. They need the money to pay their bills, and it would be good if they could pull an income from it every single month or every single year that they can rely on. So there are some key differences with funds, like being in an IRA with a company like Merrill Lynch or something, or Edward Jones, or with an insurance company. The first one would be principal protection. Not just principal protection, but principal and interest protection. So if there's $100,000 in the account, if it's in Merrill Lynch or Edward Jones, I mean, they're just regular brokerage accounts, right? And so it can gain and lose money based on the market. That's the expectation. With annuities, with insurance companies, the ones that we deal with are called fixed indexed annuities or fixed indexed. And so these are guaranteed to protect your principal, so the original money that went in, and also every single year that you earn interest, that is also protected and locked in. There are some annuities that actually will only lock in your principal, like the original amount, but you could have earned money, but you could lose the interest over the years. So ours is principal and interest are guaranteed and protected. And why is that important? You know, maybe if you're 20 or 30, then in 2008, the market literally lost 40 cents on the dollar. So 40% of people's life savings essentially were wiped away. And if you're 20 or 30, and maybe you have the time, you can afford to re-earn all that money. But if you're 50 or 60 and you're so close to retirement and you lose 40% of your life savings, then that can put a huge change in your retirement plans. And so principal protection is more important as you get older, or if your client is just more risk averse. Like I don't like the idea of losing any money, but some people might get an adrenaline rush from it, right? So you just got to know your client. Tax deferral, we've already talked about this. Again, if it was an IRA before and it's in a tax deferred account, it will continue to be a tax deferred account here. If it was a Roth account, then it will continue to be a Roth account here. If it was non-qualified account, it will continue to be non-qualified here. So if somebody has $200,000 in non-qualified, they've already paid the taxes on the money, and then they roll it into an annuity. And then over the course of 8 years, it's earned $50,000. I didn't really do the math on that. That's not very good.
Come on. Do math.
Let's say over the course of 10 years, it's earned another $250,000. So now there's $450,000 in there. Then they're going to have to pay taxes on the growth, on the $250,000. So the tax qualification does not change when you move it to an annuity. So tax deferral, we've already touched on this several times, but if something was an IRA before and you move it to an annuity, still an IRA, still tax deferred. If something was a Roth before, move it to an annuity, then it's still tax free. If something was non-qualified, so let's say that someone had $200,000 that they've already paid taxes on, it's non-qualified money, and they roll it to an annuity, and over time, let's say it earned $150,000, right? So now the client is going to have to pay taxes on the $150,000. not the original 200,000 because they already did, but on the new money, on the new growth. Okay? Fees. So, most brokerage accounts, most retirement accounts like 401k, 457, they're going to have some type of fee. And you might not even know, honestly, that you're paying this fee because they hide it really well. Some of them hide it really well. But there's maintenance fees, management fees, all that stuff. We have annuities that don't have any fees at all if your clients just hate fees. And then we have annuities that have fees for a specific purpose. So it can make sense to pay a fee for an upgrade if the upgrade is important to you, right? So you can pay a fee to have a higher than normal lifetime income, right? To have more money coming in than you would if you didn't pay the fee. And it can be worth it for the client. You can pay a fee to have a higher leave behind, right? It'll grow into more money when the client dies and leaves behind more for the family. So they're willing to pay a fee. They can pay a fee to have higher potential for growth. They can pay a fee if they want higher income if they have to go into a nursing home. So there are specific reasons why it might be beneficial for a client to pay a fee. But if they don't want to pay one at all and it doesn't match their needs, then there's no reason for them to have to pay a fee. So I've mentioned this before, but it's lifetime income. So again, how do you know how much to take out when you retire? So if you Google, how much should I take out from my 401k when I retire, you will probably run across what's called the 4% rule. 4%. And what that means is that if you have $100,000, then Forbes and all of those financial institutions said that 4% is a safe number to take out from your nest egg to confidently be sure that you won't run out of money, but no guarantee that you won't run out of money, right? So $100,000, 4%, that's $4,000 a year.
Wow.
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 Wow. Wow. Wow. Wow.
That might sound disappointing, but that's what it comes out to, right? If you read further in your Google search, then they might even say 3% or 2% is actually what you should take out from your retirement account to be really safe because we're in a low interest market. And that can be even more disheartening, right? When we do lifetime income for our clients and they're 65 years old, for the most part, they can take out 5% every single year, contractually guaranteed until they die. So it looks a lot better than that 4% or that 3%. That isn't even a guarantee or assurance that you won't run out, but just that you're pretty sure you won't run out. And I don't know about you, but I would rather not be pretty sure I'm not going to run out and just be, no, I'm sure, because it's contractually guaranteed that I won't run out. And finally, one of the differences is that an annuity can have certain guarantees to leave behind as much as possible when you die for your family. And they can do that by doing specific types of growth that's meant to pay out as a death benefit. They can structure the payout over like 5 years, and that will end up giving you more, or giving your client's kids more, or the family more when they die. So you can structure it a certain way, and there are certain annuities that are specifically designed for death benefit, for leave behind. But those are probably the main differences between having a retirement account or an account with an insurance company versus a bank. I hope this video was helpful on what is an annuity, and we'll see you in another one. So